How to allocate your investment portfolio. The key of making a lot of profit with your investment portfolio is to make sure that the portfolio does not only generate profits in good years, but also limits its losses in bad years. Easy, right? In this video, we will look at how you should allocate your global portfolio. What's up everyone? My name is Joris. Welcome back to my channel. So, you have started investing and now you want to create a portfolio of investments that can keep up with the test of times. A portfolio with perfect asset allocation includes a mix of investments ranging from extremely aggressive investments to perfectly safe investments. A combination of that will earn you the expected return over time. In this video, we will look at how to create your perfect portfolio that includes stocks, bonds, real estate investment trusts, REITs, cash, alternative investments, crypto, commodities, and even physical real estate. Now, why would you want to diversify your portfolio? A commonly known saying in investing is to not put all your eggs in one basket. Don't put all of your money in one single stock. If you were to bet all on 34 red, you might get extremely lucky and get a huge return. But generally speaking, you'd be losing money most of the time. So why would you do that with the money you have worked so hard for? By betting on the whole market as well as other types of investments, you will generate return on your investments even if the markets go down. If the stock market dips by 20%, your real estate will generate rental income. If real estate takes a dive, another type of investment will cover up those losses in the short term. The point of a well-diversified portfolio is to keep the downside as small as possible while still offering chances to get good returns on your investments. Now, before we go on, it is important for you to define the risk you are willing to take. The more possible return you aspire to get, the more risk you'll have to take. That's a decision you have to make. A return of 3 to 5% yearly is quite easily achieved with a pretty defensive portfolio. But if you're looking to get at least 15 to 20% yearly return, you'll have to look for a very aggressive and thus very risky investment. Do be aware that you can have several investment portfolios, all with different reasonings and thus different risk profiles. You could, for example, put the bulk of your money in a defensive strategy to pursue a small and steady yearly return, and then have a play portfolio with a few percent of your global investments where you can look for those big returns and you don't mind the added risk on that portfolio. Strategies can change over time, so maybe you want to take a lot of risk right now when there is little to lose at the start of your investment career, and you want to play it safe once you're about to retire to conserve your invested money. This is your personal risk tolerance and you should revisit this decision every year. Not per se to change it, but to think about it every year. So pause the video, create a positive return for this video by hitting the like button and also to subscribe to the channel and hit the notification bell. This will guarantee your investment luck for the next 5 years. Define what strategy you are after and then continue watching the video. You have an investment strategy in your mind, so now it is time to translate that strategy into an asset allocation. If you want to invest prudently by not taking too much risks, you should consider having a lot of bonds, cash and other safe options in your portfolio. Stocks can have a place in such a portfolio, but they should be limited. On this graph, you can see the risk versus return for different assets. As you can see, the more risk you are taking, the more potential return there is to gain. Equities have more risk and return, while treasury bills have very little return, but they are quite safe. You should look at this graph and see where your preferred allocation is located. This is the risk-return trade-off. This will vary from person to person and even between different portfolios in your possession. Another commonly known rule in investing is to reduce your risk over time. At the start of your investment career, when you're young, you'll have plenty of time to sit out major crashes and you can smoothen the ride over time. But if you suffer a major loss a few years before retirement, you will be forced to work longer or wait for the portfolio to regain its losses. To combat this, you should change your portfolio over time to a more defensive one. To make this scale more visible, a lot of investment companies will show you this range from low to high risk. You have probably seen this one or one similar to it in the last few years. A conservative portfolio will try to conserve the money invested in it, but it will not really generate a lot of extra money. Going to the right of this graph, more return will be possible. More risk has to be taken. Let's look at the balanced portfolio. This one is my personal favorite, and it should be the starting base for every investor. 50% in equities, 45% in bonds, and 5% in cash. I suggest only having 5% of cash max, since you already should have an emergency fund on your savings account elsewhere. To have it easy, you can make your bank do a portfolio building for you. Just go to a banker and ask for a balanced portfolio. They will most likely provide you a fund to invest in. But alternatively, you can do this yourself. For the equity part of your own portfolio, pick out shares and ETFs of your choosing. Focus on broad index funds as the base of your portfolio to diversify as much as possible without too much hassle. The same goes for the bonds part. Since individual bonds are very hard to come by these days, it might be better to invest in a broad bond fund to diversify the risk even more and to reduce your costs overall. Your main investment portfolio is quite easy to set up. It should take you no more than a few days to read up onto the theory or to watch my videos, of course. Select a few good trackers, open a broker account and get cracking. Every year you will have to revisit your portfolio to restructure and rebalance. Make sure the actual portfolio is still in line with your strategy every year. If the stock part has gone up substantially, you have to transfer a part of it to the bonds department. Once again, this should not be more than a few hours of work every year. So far for your stock market investment portfolio. Let's now look at other investments and how they find their place in your global investment portfolio. You should consider your global investment portfolio as a solid house. When you build your house, you start off with building a foundation. This foundation is needed to keep the house in place over time. Having an emergency fund close at hand is needed to survive the strongest of market storms. This emergency fund should be around 6 to 12 months of your expenses and should be placed on a savings account, preferably one where there is an actual positive return. If you have no emergency fund, your house has no foundation. If unexpected costs arrive, you will have to sell off a part of your portfolio investment. And this will never come at a good time. Believe me, your house will come tumbling down if you do not have a good foundation. When your foundations are secure, you can now build up your house. You'll build the walls, the body of your house. This is the lump of your investments, the common shares, the bonds, and the actively managed funds, and as well the ETFs. Basically, the major part of your investment portfolio. These investments carry some risk, but over time they are a rather safe investment. Once the foundation and walls are set up, it is now time to put in the electricity, the water, the flooring, and so on. Here you can use REITs, real estate investment trusts. These are common shares of companies that own, sell, and rent out real estate. So instead of investing in actual real estate yourself, you could invest in REITs. This provides a slightly higher risk than your portfolio, but once again, over time, nice returns for affordable risk. REITs are very popular because they have a rather big dividend every year, since they are required by law to pay out 90% of their profits to investors in the form of dividends. But if your dividends are taxed, just like here in Belgium, that might not be the best thing to invest in. I also dare to add physical real estate to this part as well, especially if you know the market you're invested in and you know what you are doing with the real estate. Investments with a positive cash flow are rather safe. Even if renting prices drop, it should not be a problem to pay off all these investments. Gold or other common commodities are also there in your house. Gold is often considered to have a good return when stocks perform bad, and they perform bad when stocks perform well. So it can be seen as some sort of insurance against your core portfolio. A small part of your portfolio in these insurances can be a peace of mind. Once your foundation, your walls and your utilities are up, your house is almost finished. So it's time to add details. If you are interested in investing in cryptocurrency, speculative commodities, investment real estate with high leverage, or alternative investments, you can only do that if you have a good base to start off with. Be sure to know what you do when you are investing in these riskier options, or do it with money that won't create problems if it is lost altogether. The biggest returns of your global portfolio are created in this section, but as we have seen before, the risks to achieve those greater returns are also a lot higher. It is hard to put all of the previous into percentages since everyone's strategy is different, but here is an example. Your global portfolio can consist of 5% cash, which is your emergency fund, 50% in a core portfolio, 35% in REITs or physical real estate, this includes your own home by the way, 5% in commodities, so 10% of your core investments, and 5% in crypto or alternative speculative investments. Everything really depends on where your interests lie and what risk you are willing to take. I personally am a firm believer of real estate and I've done some nice deals before. For me, my percentages are 6% cash, 13% core portfolio and common stocks, and 81% physical real estate. At this moment, I am aggressively working towards strengthening my position in the core portfolio. But I don't worry too much though, since my real estate has a positive cash flow. Even after all costs and taxes, I can still save on it. So there is no hurry to lower the bigger position of my real estate. My long-term goal is to use the leverage of the real estate to build up my wealth, and after a few years sell off the real estate and transfer the money to a passive core portfolio. To see how that will pan out in the future, you should consider following my channel. If you're sure of an investment, you can put more weight into it, like me with real estate. Just remember this, a good diversification will conserve your money. But if you want to make a lot of money, you'll have to focus on one particular section. This can be your job, this can be one in particular investment, but do know what you are doing. So, what is your strategy? Let me know in the comments below. And if you want to learn more about investing, about real estate and global personal finances, don't forget to like this video and subscribe to the channel if you have not done that already. To continue watching, click one of the videos right here. I thank you for watching and I will see you next time. Cheers!